Private credit is growing a lot. So someone in the industry actually said recently to me that private credit in the financial sector right now is the Taylor Swift of the world.
The hot girl.
So it's exactly, it's the hot girl that, everyone wants to hang out with. We are currently at an asset under management size of about $90 million, 90.
Today we're diving into the world of private credit with Johanna Krüger, an expert in investors relations and private markets. We're talking about why private credit is the fastest growing asset class, how it compares to traditional banking, and the opportunities that exist for investors, especially in emerging markets like Middle East and Southeast Asia. Johanna also shares insight on why so many ambitious entrepreneurs are moving to Dubai and what makes this city a hotspot for wealth creation. If you're curious about alternative investments, liquidity risks, and how institutional investors are navigating this space, you won't want to miss this one.
What was the most surprising thing you found in Dubai so far?
Ooh, so one of the things, I tell you this as well, is that people have a lot of confidence here. And it's one of the things that I wish I had for myself sometimes. There's no one more confident than a Lebanese man. This is true. So, but I think it adds to the beauty of the region that people are very aspirational, the big ambitions. People come here and dream and they execute. And if we think about it in the kind of the format of investing, because that's the topic for today, you also, because the lack of income taxes, you have a huge advantage being here. You're ahead of the curve before you even started. And I don't know if you're familiar with Einstein at some point saying that compound interest is the eighth wonder of the world. And the idea there is that time is in your favor. So if you can start saving, investing early and building wealth for yourself, then you're getting a big head start compared to people that have lesser time span. So no income taxes here. Amazing. Love that. That's probably one of the reasons why a lot of people ended up here as well. And otherwise specifically tied to the investment and kind of wealth space, one of the things that I've noticed in this region is that people really like tangible assets. They have quite short-term horizons and they love things they can see. So a lot of real estate.
Gold.
Fancy things as well, right? You can invest in all kinds of jewelry and some fancy handbags, these kind of things. But it's much tougher to convince someone to put money into something they can't really touch, see, or feel. And specifically when you look at longer time horizons. So me, for example, coming from Sweden, I guess I have a different mindset and perspective from the beginning, because you also have a government taking care of a lot of things for you, things like pension, health insurance, whatever else. Whereas here, that's on you as an individual. So I think we have a different perspective just within us, in the sense that a lot of things are very long term. There's no stress. Set it, forget it. It doesn't matter if it goes up and down, markets move. Not my problem. I'll touch these money in 10 years. But here it's different. So that's probably one of the big things I'd say from an investment perspective.
You came from Sweden. What about the risk tolerance between people who live in Sweden, Europe, and here in the region?
Oh, massive.
Really?
Absolutely massive. Yeah. But I think that is part to the idea that we have a government that takes care of a lot of things for you. So you don't necessarily have to think about it. And you, let's say you as a 65-year-old person in Sweden, when you retire, you have a certain pot of money that's been put aside for you. You kind of keep living your life as before in a way. Whereas here, if you didn't prepare for it yourself, you're screwed.
That's the sovereign wealth fund that you guys have in Sweden.
Pension funds,
okay,
really. But it's just the part of the whole system that we have that as a part of our social welfare, whereas other parts here, you don't have income taxes, right? So if you're not a local Emirati here, you don't get any of those benefits.
Mm. And you're recently working with private credit. What attracted you to private credit, and what is private credit in the first place?
So I'll start off with your second question. What is private credit? It's essentially getting funds or lending from someone who's not a bank. So you have non-bank lenders. And if we think about it in like the MENA terms, you have things like Tabby, for example. That's a non-bank lender. They provide BNPL services to consumers here. But you also get lending from large private credit funds, from insurance companies, from individuals like HNIs or family offices. And it's typically more bespoke solutions. So the idea is that wherever the banks cannot fulfill, that funding gap is where private credit comes in. And a lot of that was born out of the 2008 crisis in the US, the financial crisis, where bank regulations tightened up a lot, became much stricter. So naturally, you had a gap or a void of businesses, SMEs, startups not being able to access funding that they needed. And then these other players stepped in to fill that. So typically within private credit, you have a bilateral type of solution between, let's say, you needing $1 million to grow your business. I have $1 million. We agree on terms. We set it up. You pay me coupons or interest monthly, quarterly, let's say. And then at the end of it, you pay back the entire principal.
And why it's better, or what's the difference between traditional banking? I mean, is it lower interest, higher interest?
No, if anything, it's higher, but it's a whole lot faster and cater to the individual or the business that actually needs the fund. So let's take in the example, because a lot of these borrowers are startups, they're SMEs. A lot of private credit is being used for infrastructure products, for example. So let's take one of these examples, right, where you are a small business. If you go to one of the local banks here, or in a lot of other parts of the world too, and ask for $1 million because you have customers knocking on your door and you just need that to be able to keep growing, they will either say no, or they will have you go through a year's worth of checks and all kinds of processes. So at the end of that, even though you might be able to access slightly cheaper funding, it's actually not really worth it for you. Your business might not even be in operations anymore. So you will then turn to someone who's a non-bank lender and say, okay, I need this fund within 90 days. This is what I have. I might not be a great borrower from a bank's perspective, because you might not have huge capital or capex items, like you might not own, let's say, a bunch of machinery or real estate or land to put at collateral, but you have other things. Like if I understand your business a bit better than the banks, I can look at it and say, okay, I understand you're growing quite fast. You have customers coming to you that need these services. You're in a growing market. I'm happy to fund you without you needing to put your family's houses as collaterals or whatever else, because I understand the business in a different way that a bank might do.
What is Kilde, the company that you're currently working on?
We are a private credit platform regulated and set up out of Singapore, and we specialize in lending to non-bank lenders. So lending to lenders, in a way, if you think about it like that. And when you think about a non-bank lender, we're talking about consumer loan providers, we're talking about SME lenders, we're talking about automotive financiers. So the Tabbies, let's take that as an example. So they need to further grow their loan books, and that's when they come to us for funding. So let's put it in the example of Tabby. They might say, okay, we want to expand now into a new part of the world. We know that we have this pool of customers here that need this specific service. And typically, these businesses are also quite cash rich. But because of the nature of these loans, they always need additional funding to be able to operate. So we then say, okay, we typically give you a tranche or a debt line in the range of $5 to $30 million. So we say, okay, we'll take that, we'll fund you that so you can keep growing your loan book. And in exchange, we take a pledge on your underlying portfolio of consumer loans. So in the event of a default, knock on wood, if anything were to happen, then we own the underlying portfolios that we've taken a pledge on. So Tabby, let's say, they go bankrupt. We're like, where's our money? We then take that underlying pool of collateral. Those consumers that were paying interest to Tabby now pays it to us. And then we distribute that further to our investors. And then to give you both perspectives on this platform side, so that's the borrower side. Those are the non-bank lenders that we lend to. But then on the investor side, we have two different arms to the business. So we're licensed as an asset manager, meaning that we can deploy monthly on behalf of institutional investors into our deals. And that is pretty much our value add also in this chain, that we're very good at finding these deals, originating them. We're good at structuring the tranches, because that's a whole kind of knowledge in itself. And we're good at monitoring them, which is the third and very important bit of it too, right? Because if you give funds to Mahmoud's cake businesses, I don't know how the cakes are selling and what's happening afterwards. There's obviously a chance that you're going to default or disappear or something else. So it's very important that I also keep that in check to make sure that you're paying on time. Is the cake sales going as planned, etc. So there's one part of that, the asset management arm. And then we're also licensed as a broker dealer. And that means that we can take part of these larger tickets, so let's say a $5 to $30 million tranche that we're structuring for someone, we can take part of that, break it down into smaller debentures on the platform and list it so that accredited investors can get access. And an accredited investor, as per MAS in Singapore, is essentially an HNI, someone that has certain financial assets onto their name.
So over $1 million in cash.
Yeah, 1
Beside
million
his home.
financial assets over 1 million Singaporean dollars. So it's like 750 something US dollars.
But just to go back to the asset management, you said finding the flow, the deals, structuring them, and monitoring them. How do you find deal flows? It's a really tricky. How do you find good companies?
A lot of this is thanks to our CEO and co-founder Radek as well, and his work life before this, and our shareholding and the people that have been involved in setting up Kilde from the beginning. So Radek, as an example, he's a Czech Republican guy, but spent a lot of his career working towards Southeast Asia and Singapore, consumer financing products, which very much reflects what we have in the portfolio. So if you look at the borrowers that we tend to, they're roughly 50% based in Asia and 50% in Europe. And in Europe, they tend to skew Eastern Europe. And that's mainly because of the return profile that we have. So we have historically netted returns to investors between 12 to 13% per annum.
Do you guys invest in a very specific domain? Is it a consumer? Is it B2B? Is it deep tech? Or like, depends?
So it's always a lender where we can take a pledge on an underlying portfolio, but then they could in turn lend to consumers, they could in turn lend to businesses. So that's kind of a 70-30 split for us. We have about 70% consumer lending assets in our portfolio and about 30% business lending. But when you look at the markets, why we've ended up more Eastern Europe, not only because Radek is a Czech Republican guy, but also because of the return profile. So we make sure that we're always senior secured and asset backed on our deals. And what that means is that in the capital stack, if something were to happen and you need to come in as a lender and say, give me my funds back because you now went bankrupt, then when you're senior, you're at the top of that stack.
The first one to get your money.
Exactly. You're the first one to get your money back. And then you have a mezzanine layer and then you have a junior layer. And you obviously get priced accordingly. So if you go in as a senior lender, you get slightly less returns because you're taking less risk. If you go into the mezzanine stack, a little bit more. And if you're in the junior stack, you get higher returns. And we always operate in the senior secured segment of lending. And asset-backed means that there's an actual assets behind that we can take as collateral. So in our case, it's these portfolios. And because of us being in that senior secured asset-backed segment, which is the very top of the pyramid, and having delivered such high returns to investors, like 12, 13% per annum, naturally, when you go more to the west parts of Europe, you don't really find that. Those returns drop a little bit because you have other banking institutions and similar that fill that gap. But emerging markets, you can find these kind of deals. So that is our sweet spot.
Okay. So you guys are a liquidity provider for other lenders who are non-banks.
Yeah, you can think about it like that. Exactly.
The reason why you guys found a sweet spot because you think that liquidity is going to be short for the next 10 years or no, not really?
No, well, it's just a gap. Like private credit is growing a lot. So someone in the industry actually said recently to me that private credit in the financial sector right now is the Taylor Swift of the world.
The hot girl.
So it's the hot girl that everyone wants to hang out with, and a little bit. I mean, hopefully, right? But that is what's happening with private credit right now, and it's been growing a lot. So we're almost at $2 trillion just in private credit market size. And if you compare that, for example, to 2009, it was 10x less than that. So it's been quite fast growing. And predictions now, I looked at a Preqin report, for example, that was talking about where it would be for the next 5-ish years. And it's expected to be another 3 to 5 trillion, or total, 3 to 5.
So you lend money to those lenders. But for example, in a market like Southeast Asia, I'm assuming that there's like 2 or 3 big lenders, or no, it's more fragmented than this.
It's fragmented. And you also, so the issue when you try to reach these NBFIs from an investor perspective, right, is that you have a certain geopolitical risk, obviously, depending on the country you select. And also you need to be able to enforce if something were to happen. And that is where someone like Kilde comes in, because we understand the markets. We have hands and feet on the ground in the sense of being able to collect if something happens. And these are all a part of our structures and our contracts. So if, for example, let's say you really believe in I don't know, the Balkans in Europe, and it's something you want to get access to. For you as an individual, even if you would have really deep pockets, it's really, really tough to do it. It's tough to structure the tranches. It's tough to find the right kind of borrower. It's tough to enforce if something were to happen. I mean, do you rock up at the airport and just try to find them? There's a lot of checks and balances in place. And that's where someone like Kilde is really helpful.
No, so you guys have access to those deal flows, and you guys structure them in a way where you guys have the less risk because you're the senior person. And then the last part, you guys monitor. What exactly do you guys monitor? You guys monitor those specific businesses?
So we monitor the loan tape data, which is something that borrowers need to share with us. So essentially what happens is that, let's say you are Tabby, and every month, or probably live actually, you're getting all the updated loan data on who's repaying your loans, who's defaulting. You probably have a certain percentage as well, right? That you know that roughly this sliver of my consumers are not going to pay me back. So you put together a portfolio now that we've taken a pledge on, and we monitor that portfolio. And then we have certain checks and balances in place to make sure that that portfolio stays healthy. So for example, one of our terms is that if you see that in this specific pool that we took a pledge on, that you're starting to have, it's called the days past due, where people aren't paying, let's say in the 30 days or the 60 days or the 90 days that they have. If these loans start to trickle into our portfolio, we then say, okay, actually you need to replace these unhealthy loans with healthier loans from elsewhere. So there's a lot of ways to work with that to mitigate these risks. But those loan tape data, or the data files are what we analyze. And then we have our own machine learning models and our own credit team that sit and look at that and say, okay, is it moving the way we want it to move? Are we afraid of any defaults or any issues? These kind of things is what they're looking at.
And is private credit correlated to the market? So let's say if I own private credit, I own S&P 500, if the S&P 500 went down, will the private credit go down as well, or is not really correlated?
It's not correlated, which is why also a lot of people now are moving into private markets. So we've had a really kind of bull run with public market for some time. And a lot of these big now institutions, insurance firms, family offices are looking towards private credit because of its not being correlated to public markets. And a classic kind of 60-40 portfolio where you'd had 60% equities, public equities, and 40% fixed income, which is also publicly traded. A lot of people there have now started to add 5-10% of their total portfolio within private credit. And it's something that we're seeing as well. So me specifically, I speak to the institutional investors globally, and some of our individual investors as well in certain regions. And I'm seeing a lot of more interest amongst the institutions to learn more, to understand a little bit. Can we kind of dip our toes into it? And because we function as a platform, we're not a fund yet, at least it's something that's coming. But because we function as a platform, it also means that as an institutional investor or individual investor, you invest on a deal-by-deal basis. So you can dip your toes in that way, right? Where you say, okay, I want to put aside a little bit of funds here. I want to try maybe certain parts of Europe, or I want to get exposed to whatever Kilde has in Singapore. Or I really believe in Central Asia, for example. We've done quite a few deals there. Give me access to those deals. So that's how we operate. And then we help these institutional investors because they typically have very specific mandates. So we then help guide them and say, okay, you need at least 12% per annum returns. You need these products to be quite liquid. So maybe you require quarterly redemption options, which just means that you're able to get your capital back every quarter if you need to. So depending on your own parameters, we then help fit that with the deal portfolio that we have and then help you invest and employ into these deals.
So who are the people that want private credit on the portfolio, and what exactly the problems that you guys are trying to solve for them? Yes, I want to know who's the personas that want to invest private credit. Is it like institutional investors, high net worth individuals, retail investors, governments, funds of funds? Exactly who actually want to have private credit on the portfolio?
I would say all of the above, to be honest. No, it's just as in the financial sector, it's one of the fastest growing asset classes now for the past 15 years. So all of the above have an interest in it. And then if I think about it from the perspective of Kilde, where we've seen the strongest growth is on the accredited investor side. So those would be your individuals. And we now get a couple of signups from individual investors wanting to get access to these deals per day. And then we help onboard them and we help them invest these funds pretty much. So it's, from what I've seen, that segment, at least for us, is faster growing, but it's also quite natural because of the nature of these investors. So obviously, as an accredited investor, you can move very, very fast, and you can say, okay, I sold something, so I have some extra liquidity. I want to put it into something that's secured and asset backed. I don't necessarily want to gamble with it, and I really like these returns. So here, let's do it, and that can happen within a day, really. Whereas institutional investors usually have quite lengthy processes to get this done. It could take a year for them to get it through the investment committees and pass all the checks that they need to have them pass through. But to answer your questions, definitely both, all of them, all of the above.
But so why it's attractive for accredited investors? You mentioned that one, it's not correlated with the market, so it's a good for diversify your portfolio. What else?
So it depends a little bit on the lens that you have coming into it, because what we're seeing is that certain individual investors, accredited investors, they might compare it to, let's say, a money market funds or a fixed deposit in the bank. So they're saying, okay, I have some funds sitting here and I'm getting in my bank, I'm getting 3.5% and I need to lock it for a year. And in the money market fund right now, you're getting like 4.25-ish percent per annum. So if you're telling me I can get somewhere between 11 to 15% in these senior secured deals, I'd much rather park it there. So that's one angle when you're then comparing to kind of where is my money just sitting today versus what could I do with it when I don't really need it for something. And we're seeing investors on that accredited investors on that side where they also need the liquidity. That's usually one of the big selling points for us. So we negotiate with all of our borrowers that we need put options on these deals. And it just means that you can access your capital. And usually these put options are quarterly. So it means that as an individual investor, you can then say, okay, actually, this year I'm going to buy a house and I need my funds back. Then you give us a heads up. And within that next put option period, you have your funds back out. So that's also one point that's really important usually to investors. The other one I'd say is that you get access to these deals on the exact same terms as institutional investors. So we call it institutional grade investing. So structurally speaking, the SPVs that you invest into that do the lending to these borrowers are the exact same, your pari passu, which means that you're at the same level and same terms as everyone else in that SPV. So it means that Mahmoud investing into these deals, he's doing it at the exact same terms with the exact same return profile as a pension fund, a professional private credit fund, or whoever else is investing into them.
And what things that need to happen in place to make private credit grow in the next 10 years? Economic stability, lack of liquidity in the world. What exactly you guys need for private credit to flourish in the next 10 years?
Even the way it's been going, I think we could just kind of keep that. So tightening banking regulations, that's one big part of it. Because if businesses or consumers cannot get the funding needs that they have from a bank, they will turn elsewhere. And elsewhere is a void where we can then fill. And specifically within emerging markets, there are bigger voids like that. So I think don't change much, just keep it the way it is. And there is a lot of room for private credit. And the other thing that people usually think about when for the specific purpose is also the risk of the underlying. Because, for example, 2008, one of the reasons why this whole thing really blew up was because of how these tranches or the credits were structured. And the actual end user were not necessarily a credit-worthy user to have all these mortgages in the US, for example, and owning all this real estate. Whereas if you look at private credit and you look at pure bilateral lending, bespoke type of solutions, where it's just me saying, okay, Mahmoud, you have a business. I understand your business. Here's fund. you pay me in whatever fashion we've agreed on. Then in the end, you're paying me back because now you've grown your business and you have more money. Done. So obviously the underlying risk there is a general recession or a market downturn where all of the businesses then, let's say in this area, cannot repay. But it's not quite what people might think, as in this kind of really leveraged, scary type of loans that we had in 2008, for example.
And what are the main risks in private credit?
Illiquidity is one of the big ones, and which is also why you're getting higher premiums than what you do in a public market. So a public market, you have clear pricing and you can get rid of something instantly, because there are secondaries to pick that up. In private markets, you typically don't. So illiquidity premium is something that you're getting compensated for. But our deals, for example, tend to have a duration of 6 to 36 months, meaning that we lend 6 to 36 months.
Okay.
So no more than 3 years.
Okay.
So you would then lend your funds to someone for 3 years, let's say, but then you have these quarterly redemption options. So if you want to access your funds earlier, you can. It doesn't cost anything. We're not penalizing you for it. It's just an option.
So you mentioned illiquidity is one of the risks. What else?
Yeah, so looking at risk and returns, illiquidity is definitely a risk, which is why you get higher premiums on your money. You also have diversification purposes, for example, which is one of the reasons you would select private credit. So a lot of people trying to access this asset class, like we were speaking about, it's tough, right? Like, where do you find these deals? How do you structure them? Do you go up to these businesses and do it directly? You need an intermediary. And a lot of people then use private credit for diversification purposes. And you then specifically within this type of segment, you need to find someone that is very good at what they're doing in their specific niche. For us, for example, our niche is the non-bank financial institution space. So that's where we're good. We're not very good at, for example, valuing real estate or other type of assets that someone else might be very good in doing. But for us, we stick to the NBFI, consumer lending portfolios, business lending portfolios. That's where we're good.
What advice would you give to someone looking to enter the private credit market?
So from an institutional perspective, I'd say start there with finding someone that is very good at the specific niche you're trying to get into. So if you're looking to diversify in a certain part of the world, find people that are there or a private credit manager that operates there. If you're looking to diversify into a specific type of asset class within the umbrella of private credit, so then let's say NBFIs, right, for us, then find someone who specializes in NBFIs. If you want to get access to mortgages as the underlying, find someone who's very good at valuing real estate in that specific jurisdiction. That's typically how you see the best returns for this specific group.
So what makes the ideal borrower for Kilde?
So apart from being a non-bank financial institution, that's very much number one. We ideally want to find NBFIs where we can grow with them. So we, let's say, provide a credit limit to you as an NBFI of $20 million, but we don't just provide that as a one payment up front. We might break that $20 million into multiple tranches and give you then, let's say, a total of 5 different tranches at $4 million each. So what happens then is that we want to make sure we're not exposed to more than 20% of your total loan book. And naturally, as you grow, we can unlock more funding to you. And that's also a part of our responsibility as the credit manager, that we're doing this covenants monitoring as you grow the business. We see that you hit your goals and KPIs and the financial covenants are being met, and then we unlock additional funding. And a typical borrower for us, a perfect borrower, has an AUM size, which is assets under management, of somewhere between 20 to maybe $350 million, which is quite a span. But that is typically where our type of funding and these return profiles fit in the best. And if you think about it in the sense of a Moody's and Fitch rating, we like to operate in the segment of the triple Bs to the single Bs. And I don't know if you're familiar with this, but if you go higher than triple B, you're in the A segment, which is the highest rated in terms of credit. And they become too good for us. They're essentially able to get cheaper funding elsewhere, which is not where we shine. And if you drop and you move into the C segment, then you're too risky for us. And we like the senior secured asset-backed space. So that's where we're good. And so far, we've been around since 2019, but we've had 0 delinquencies and 0 defaults.
Oh, wow.
So it's as a testament to these rigorous processes as well that we have in place and how we structure and operate these deals.
How you guys have 0 delinquencies? That's very impressive because, I mean, I don't know what's the industry rate, but it's usually very high.
Because of some of these reasons that we spoke about. So, for example, that if we see in your loan portfolio that we took a pledge on, that there are now starting to come in unhealthy loans that are having these DPDs, so like day past due numbers of more than 30 days or 60 days or 90 days, then we tell you, you need to replace these loans with healthy loans from elsewhere. So that's one of the things to do it. The other one is having the put options as well. So for example, if we were to see that actually Mahmoud's business is going to shit,
Fair.
it's not at all moving how we expected it to move, then we can say, actually, we need to pull the capital back. And because we're not exposed to more than 20% of your total loan book, it also gives us a little bit of room to be able to do that. Because otherwise, naturally, you can imagine if we funded your entire loan book and said, tomorrow we need our funds back because your business is not doing well, the whole thing is bankrupt and kaput. And it also is the beauty of the underlying assets that we invest into is that these businesses are typically very cash rich. And a lot of these loans, when you look at consumer lending loans, the tenure of those loans towards the consumers is usually no more than, let's say, 90 days, sometimes 60, sometimes 30, like the BNPL kind of structure. So you might need to purchase something as a consumer today, and then at the end of the month, when you get paid your salary, you've paid it back to Tabby or Klarna. So naturally, because of the underlying nature of those loans, it also makes it much more realistic for someone like us then being a lender to those businesses to say, actually, now your business is moving a direction we're not comfortable with. We might need to pull the capital back. But ideally, I mean, this doesn't really happen often because we want to grow with these borrowers. We spend a lot of time and effort selecting borrowers that we think are good to work with and that we see a lot of growth potential with. So the idea is that we can keep funding them as they grow. And also from our perspective, it's the same amount of work to structure a $100,000 tranche as it is to structure a $100 million tranche. So we'd much rather do that and be able to get more investors involved than doing all the same work for a much smaller chunk of investments. Now we have like $90 million in assets under management for us as Kilde.
I know you're very interested into investor relations, and what are you seeing in the sentiment currently here in the region, raising money?
So I'm based here, but I focus on fundraising globally. Okay. So institutional investors I cover worldwide, and then individual investors for certain parts of the world. And if we start with the institutional segment, we see most success with family offices, with other institutional investors that understand our asset class. So someone that might have done NBFI investments in the past, or they focused on emerging markets, which overlap with the specific emerging markets that we are in, so Asia or parts of Eastern Europe, let's say. We typically don't find much success with an institutional investor that have never done it because the learning curve is quite long. And also from their perspective, like we said in the beginning, it's a time-consuming process. So for an institutional investor, from the day they start learning about something and reviewing the deals and doing their due diligence until the funds are actually placed could be easily a year. And that adds on, obviously, if it's someone that needs to then educate their investment committee, they're trying out something new, they need to verify who's the manager, us in that case. So someone that has kind of dipped their toes into it already is obviously a much easier conversion process from our perspective. But then it is becoming a more and more interesting asset class now for investors, just globally speaking. So we do also see more interest from investors to kind of learn, to understand a little bit, to review some of our deals, to be involved, for example, in us sending them updated deals whenever something else launch. So we try to do about 1 to 2 new deal launches on the platform per month on new issuances. And they want to stay in touch with us to understand who's coming up, what are the return profiles, what geographies are they in, could this be something for us? So there's a lot of that kind of educational component to it as well. But definitely if you're a family office, if you're an institutional investor that kind of understands the space, that's a whole lot better for us. And or less time consuming, I should say.
What about sovereign wealth funds here? I know they allocate like 2% on the private credit.
To be honest, for us, they're too big. So we are currently at an asset under management size of about $90 million, 90. And when you're a sovereign wealth fund, typically, if you're looking to get into something new or dip your toes into something, or even if you've done it and you just want to increase your exposure allocation, you tend to go for the biggest names in the industry. So for us, that would mean Ares Capital, it would mean Blue Owl or someone else like that. It's not Kilde, that's for sure. So we typically are not the first choice for some of these bigger sovereign wealth funds. We'd go slightly smaller, and also because of the tickets that we place. So we're somewhere $5 to $30 million, and a lot of these sovereign wealth funds, they need to be able to place at least, let's say, $500 million into then a couple of deals of their choice for it to even make sense to have the conversation. So that also means it's capital that we can't cater to, because it's not as easy as like, hooray, someone wants to give us $500 million to invest. Like, yippee. We then need to make sure where the heck do we find deals then worth that amount of money that we can deploy that fast into.
Can you focus down which market specifically? You've spoken generally overall.
Because we have a portfolio that's split roughly 50-50 Asia, Europe, naturally we see stronger interest from institutional investors that are based there as well. So it's easier for an Asian institutional investor to understand and deploy funds into Singapore or Philippines or Indonesia. And vice versa, when we look at our European part of the portfolio, it's much easier usually for, let's say, than a UK-based institution or a Luxembourg-based fund, for example, to deploy into that. Less easy for someone who is in the Middle East, for example. Typically what we're seeing here with institutional investors is that they prefer to not have their funds being pulled out of the region. They like to reinvest it. And we're actually looking and evaluating some opportunities in the Middle East. So it could be something that we can do more with in the near future. But for now, with the type of deals that we have, typically Middle Eastern institutional investors will want to do something that can come back to the region. So they might be keen if we had Tabby, for example, right, in our book. That might make sense because they understand it and it's here. But when we say, okay, we're going to do the NBFIs in Mongolia, it might be less relevant. It's a little too exotic, essentially. And the other thing here that we're seeing, because the sweet spot for us is also like the family office segment, a lot of family offices here, if you look at the local, or at least the Arabic part of the family offices, they don't necessarily function like family offices elsewhere. And it's a lot of times in the sense that they might be very good at investing into something very specific. A lot of it is real estate. So it could be, let's say, then someone in the 60s, 70s, 80s, everything was booming. They had some sort of trading business, or they owned some land or real estate or something, started generating money, usually put it into real estate in a lot of cases. And then, I mean, we've been here now for the past 10 or 20 or 30 years, and we've seen how it's grown. So then these assets, if you owned a small building in the port of Dubai in the 70s, I mean, now you have some serious money on your hand. But these investors are typically less interested in kind of going outside of what they're comfortable with.
You came from Sweden and you integrated the culture and you had a huge success here in Dubai. But do you have any advice for a hungry person that coming from Europe and want to succeed here in the Middle East?
Oh, I think just do it. And now you have so many people that have ended up doing that specific route. Coming here, there's a lot of things happening here. I think just try it out. And that's anyways a trend that we're seeing right now, that people end up here from not just Europe, but from parts of Asia, from parts of the Americas. If you have someone that you know in the region, obviously that's a big head start. Try to go that route. Whatever it is you're trying to do, set something up on your own or a job, whatever, that always helps. But definitely be here, try to do things from the ground. I've tried to advise some friends and acquaintances from back home wanting to kind of explore this part of the world, but it's really tough if you're not here. And specifically within the scope of fundraising, you really need to be here. But even someone just looking to kickstart a career or try a new job or do the same thing they're doing, but in a different part of the world, just physically be here. It helps.
Johanna, thank you so much for your time. It was a great episode. But where can our audience go find more about private credit, about Kilde? Who is our ideal person to talk to you about?
So I'm more than happy to answer to any sort of questions people might have. You can find me on LinkedIn.
I'm included in the show notes.
You'll add that. You'll find Kilde at kilde.sg, and we have a statistics part of our website, which is quite useful. We're very active on LinkedIn as well, so you can download white papers and things like that there. And if you're someone that fulfills the accredited investor criteria and wants to actually start investing, or you're an institutional investor, then I mean, by all means, reach out, hit me up, find me, and we'll talk you through it.